Chief Investment Strategist Liz Ann, good to see you. Thanks so much for joining us.
My pleasure. Nice to see you too, Will.
So today's rebound intraday, do you think that marks in the short term the end of this pullback, or is there more to come?
Maybe not. We're really in a churning phase right now, and I don't mean that just with the use of the term generically. When you look at indexes like the high-low index and the fact that a large number of stocks are making both new highs and new lows simultaneously, that is a sign of churning, and that tends to persist for a bit longer than what we've seen so far. You know, on a closing basis, you didn't quite get the NASDAQ into correction territory. We did on an intraday basis from the high to low, and I think there'll probably be a bid that's found for the higher quality companies, but there's probably still a bit more valuation reset that has to occur among some of the really lofty multiple parts of the market, obviously driven by the move up in yields.
We've been focused on tech for obvious reasons during the last couple of weeks in terms of what's ripe for a pullback. Are some of these cyclical sectors looking a little overbought now as well?
So I think there's a difference between maybe technically overbought areas, possibly within financials and energy, that have clearly been at the heart of some of these leadership surges, especially since early November, which of course was in conjunction with the start of the positive vaccine news. So I think technically you might be there, but from a valuation perspective, I don't think that's where the heart of the multiple issue is that sort of necessitated a re-rating by virtue of the spike we started to see last week in yield. So it's a question of whether you're focused on technicals, if you're looking to take profits, multiples, or just recent price strength. I think those are sort of three different buckets, and there can be some overlap, but it really depends on what your bias is in terms of what might be driving some of that profit taking.
So, Liz Ann, what's the advice right now?
You know, given how rapid some of these moves are, you're seeing really wide dispersions among sectors from, you know, best performing sector to worst performing sector on a multi-week or monthly basis. And I think what that environment suggests investors should do is not try to anticipate what the next short-term trend is going to be from a sector or even factor leadership, but do more portfolio or volatility-based rebalancing. So a lot of investors rebalance based on the calendar. They might do it annually, they might do it quarterly, they might be in a program that does it based on the calendar. But to the extent you can do it, maybe let your portfolio on a shorter term basis drive where that rebalancing occurs. And then it just forces us to do what we know we're supposed to, which is not so much buy low, sell high, but add low, trim high, and stay in gear by effectively reacting to what the market's doing. And by that, of course, I don't mean chase what the recent hot area is, but force yourself to pare back where you get profits in the short term and add. And again, just try to stay in gear. That's about the best thing you can do in this very, very choppy, churning environment.
Is the key for next week, Liz Ann, what the long end of the yield curve does, and if it rises more than expected again, will that spook equity investors?
It depends on the mix driving the move higher in yield. It's you know, a combination of growth expectations and also inflation expectations. On a 65-day rolling basis, we did just see the correlation between treasury yields and equities go into negative territory, but I think a slow move up in yields, unlike the kind of spike we saw mid last week, which was driven by some technical factors and the week 7-year auction, if it moves into slower fashion and it's more on the growth side and less on the inflation or inflation expectation side, that's not necessarily a bad environment for equities. But if we start to see the opposite of that, and the pickup in inflation starts to exceed the outlook for growth, that's when you tend to get into negative territory for stocks. So it's not so much the level, it's the speed in the mix.
Shepard Smith here. Thanks for watching CNBC on YouTube.